All right, good evening. Thanks for joining. I'm offering this session at the midpoint of the simulation because by now I have read a lot of your comments as you submit your reports, your decision rationale every week. And when I read those, oftentimes I get the feeling that a lot of you don't really understand how some of the fundamental things in business accounting work. So I wanted to spend a little bit of time of explaining this and why I keep asking you to calculate the cost per unit. Because if you don't calculate the cost per unit, you're basically flying blind. And I will show you this with my little spreadsheet that I created and that we will go over, and hopefully after that this will be more clear to you. But before I start, I wanted to say MSBA 300 is the beginning of the MSBA program, and as a business analyst you will oftentimes have the opportunity to work on data and have to figure out how the data is related and how to really make your way through understanding the data. And we teach that, and especially in this class, MSBA 300, there's a lot of theoretical concepts, but the simulation is supposed to give you a practical understanding of this. And it also gives you a practical understanding of the difficulties of this, because there's a lot of data that you have to understand. And it becomes a lot easier to understand the data and how it is related if you understand some of the rules, how the data fits together. Then it becomes much more manageable. And that is easier if you have business understanding and a business background. So the purpose of this section is not to turn this into a class about accounting or an MBA class. The purpose is to show you how much easier it gets if you understand how the different data elements work together. And in business, it's fairly easy. We don't need an advanced math degree to do that. We just need to understand how the numbers work together. So does everybody see my screen? Can somebody go off mute and tell me if you can see my screen?
Yes.
Okay.
Yes, sir.
Okay, so let me explain what you see here. In column B, I pulled numbers from the simulation in the year prior to the start of the simulation, so this is 2018. I pulled the revenue. I know the price is $7, so I calculate that the volume was 32 million. The volume is not in the income statement. That's why I calculated it. What I see in the income statement also is the fixed cost of $87 million and a variable cost of $67.6 million. I also see other costs of $32.9 million for a total of $187,500,000 in cost. And when I take revenue, 225 million minus cost, I get the operating profit. Okay, so far so clear. Now, the next thing I did is I took the fixed cost and divided it by the volume in order to calculate my fixed cost per unit, which is $2.70. And I did the same thing with the variable cost, which is $2.10, and with the other cost, $1.02. So when we start the simulation, our per unit cost is $5.83. That means I'm generating at a price of $7 a profit, an operating profit of $1.17 per unit. So for every unit I sell, I generate an operating profit of $1.17. And this operating profit is what I use in the scoreboard. I don't know if you guys saw the scoreboard, but in the scoreboard, I basically use the operating profit as aggregated profit to score and give you an idea of where you're standing compared to the other students. You're not graded on how much operating profit you generate, but if this was a game, then the rule of the game is to generate as much operating profit as possible, because that's what we do in business. Businesses are valuated at the stock exchange about the multiples of their profit and earnings. So I wanted to show you, as I promised, how you can use these numbers to actually get some insight. In order to do that, I created here a second column where I mirror this and where I can play with the numbers, and you see how it contrasts with the original numbers. So the first thing that I wanted to show you is what we call in economics the economy of scale. The only thing I'm going to change here is the volume. So what if I generate a volume of 40 million units? I'm not changing anything else. In economics, we call that ceteris paribus, so everything else equal. At a volume of 40 million, we now see how the numbers here changed. The fixed cost stays fixed. So that's why it's called fixed cost. The fixed cost stays at 87 million. So think about the fixed cost as being your buildings, your rent, vehicles, whatever you pay a fixed amount, no matter how many units you produce. That's your fixed cost, and it stays the same. However, on a per unit basis, the fixed cost goes down because the more units I produce, the lower my per unit cost gets. I could type in here, for the sake of the argument, for example, 80 million units, and you see how my per unit fixed cost is suddenly only $1.09. Okay, so let's go back to 40 million units, which is a little bit more realistic. 40 million units, my per unit cost is now only $2.18. My variable cost is fixed at $2.10. Variable cost is defined in economics as the cost that it makes, the cost that it takes for one additional unit. So this is the cost of the ingredients, the cost of the actual production, the bottle that you fill it in or the box that you put it in, etc., etc., the variable cost. And the variable cost stays fixed per unit, but it varies how many units you have. So when I read a comment where somebody looks at the previous year and says, oh, I'm worried because my variable cost increased, then I immediately know that you don't understand this very fundamental thing, because as you produce more units, your variable cost invariably will go up. If I produce one unit, you will see here that my formula explodes a little bit. And you see that my variable cost is $2.10. You see that my fixed cost explodes, etc., etc. But my variable cost is still at $1.10. That is not the goal, to reduce your variable cost, because now I produced only one unit and my price per unit is basically $119 million for that one unit. There will be very few people that buy that would buy a bottle of laundry detergent for $119 million. So your goal is not to reduce your variable cost. So if you're worried about your variable cost, you simply don't understand how the numbers work. That's what I wanted to say. So don't worry about your variable cost going up. The variable cost is fixed per unit. You see the other cost also stays the same because the other cost in the simulation is dependent on the revenue of the prior year. It's a percentage of the revenue of the prior year. You don't have influence on that. It's automatic. So the more revenue you generate, so let's say if I can generate a demand for 40 million units, I sell all these 40 million units that I produce, I will generate a revenue of $280 million. That means my other cost next year will be higher, which also means I have a higher marketing budget and a higher trade channel budget that I can allocate. So you cannot influence your other costs at all. And so you see that my overall cost went up, but my cost per unit went down. Jeremy, could you please go on mute? Jeremy, I hear some.
Yep, apology.
Okay. So the overall cost went up.
I have a question.
Okay. Go ahead.
Professor, how do we decide that what should be the volume for next year?
I'm not there yet. Can you hold on questions until I'm done?
Okay.
Okay, so our overall cost went up, but our cost per unit went down from 583 to 510 per unit. What you will see now is that our operating profit went up significantly, and there's two reasons for it. First of all, I sell more units, and second, I sell more units at a higher margin. My margin went up from $1.17 to $1.90, the difference between $7 and $5.10. So I make more margin on more units, which means my operating profit went up. There's only one problem. All things equal, I will not sell more units. So if I produce 40 million units, and this is also a mistake that I often see in your comments, is where you say, I want to produce that many units because I want to get my cost down. That's fine, but that doesn't do you any good if you don't generate the demand to actually sell those units. Because if you sell only, let's say, 35 million units, you will have 5 million units go into inventory. They're unsold, so you don't get the revenue for those units, and you don't see the benefits of the economy of scale. So the real question is, how do I get my demand up? And then I calculate the demand, and then based on the demand, I take the demand that I will generate minus the inventory, and then I know how many units I produce, and then I can do the calculation on the units. But I want you to understand how the numbers work together. So one of the ways how you can increase your demand, and I hope you all figured this out by now, is you can change the formulation. If you go in the Data Explorer and you figure out the demand, you can filter it, and you can look at demand by formulation, and you will see that by far the highest demand is for pots. There's also high demand for liquid and a lower demand for powder. But we also know that liquid, for example, is more expensive by 7%. So sometimes I read the comment, I would like to sell liquid or powder, but I have to increase the price in order to be able to maintain my margin to do that. And that also tells me that you don't understand how the numbers work. And let me prove to you that that is the case. Because if I now increase the variable cost by 7%, Variable cost now went from $2.10 to $2.25 to reflect the cost increase for liquid. And again, I didn't change anything else. So I'm making now 40 million units of liquid, which, by the way, since liquid has a higher demand, I have a much better chance of selling 40 million units of liquid at $7 than if I stay at powder. Now let's look at what this change did. So my variable cost increased, as I said, per unit, and my overall variable cost also increased. But since I am producing more, I still have the lower fixed cost and the lower other costs per unit. So my cost per unit is still at $5.24, which means it is still lower than at the powder at a lower volume. And I'm still making 186% more margin, so 86% more margin, essentially almost double the margin than I made before. Again, same price. So with other words, I do not have to increase the price in order to produce liquid. I can keep the price the same, switch to liquid, therefore generate a higher demand, and I still have a higher profitability than I would have stayed at powder. Now you will say, well, how does it look like if I switch to pots? Because I know that pots is the highest demanded formulation. Well, let's look. What does it look like with pots? Well, with pots, at 40 million units, I still generate 168%, so 68% more margin than at powder if I generate 40 million units. So let's look at these numbers. I kept the price the same, $7, because I know that pots are the highest demand. I probably have a chance to get to 40 million units demand. What it did is it increased my variable cost by 15%, but I still have the lower fixed cost per unit and the lower other cost per unit. So my per unit cost, even at pots, the most expensive formulation, is still over 40 cents, 42 cents lower than it used to be with powder at the lower volume, okay? And that is really crucial for you to understand. So if I read comments that say I have to increase the price because, you really should make sure that you understand how these data items, fixed cost, variable cost, other cost, how they work together. Because in many cases, if you misunderstand that, you make decisions that are not routed in data, that are not grounded in data. Now, Mamta asked me the question, how do I know how much demand I generate? That's why I wrote in the instructions. This is one of the things that is incredibly frustrating to me, that I write very detailed instructions for you guys, and you all, well, not all, but some of you choose to ignore my instructions. Because I said in the instructions, the last thing you do is, after you decide on formulation, et cetera, is use the demand forecast tool, which is built into the simulation. The demand forecast tool helps you to actually forecast demand. And it forecasts the demand in a range, so you can see the lower and the upper end of the range that is forecasted. And then you can see if 40 million unit demand is realistic or not. And if it is realistic, then you would see that this calculation that we did here would work. Or maybe you can generate even more demand. The other thing that you can play with is, how low can you go in price? We're halfway through the simulation, so by now you should have all found the price point demand in the simulation. I have, let me see if I can pull that up here. The price point demand in the Data Explorer tells you that the price point demand is the highest under $5, and then there's a huge drop in for the range between $5 and $7, and then there's a further drop between $7 and $9. That's a very, very easy to understand chart, which is why I'm always surprised that that somebody would have a problem understanding this. Let me pull it up here. I'll have it in a second. Okay, so here it is. So we see here the price point demand in units, and you see that by far, the demand in units is the highest for $5 or less. And then you see a dramatic drop from 11 million units roughly to less than about 2 million units in the price range of 5 to 7. And then you see another drop for the demand from 7 to 9. And then you see how minimal the demand is, relatively speaking, for more than $9. So, and you can see how big the difference is in if you raise the price from $7 to $7.50, you jump from the blue line to the yellow line, meaning your potential demand in the price range between $7 to $9, so at $7.50, is significantly lower. And if you would go from $7 to let's say $5 or less, your demand will increase enormously. So now that we know this, which again is all stuff that you could have known before you did the first exercise, because this is all in the Data Explorer and this is all data you can see prior to the first simulation. So let's see what happens if I reduce my price to $6.50. So now I see that at $6.50 with pots, I am still making 15% more profit if I produce 40 million units than if I have demand for 40 million units. But we did now two things. We decreased the price and we went to pots, which probably is more than enough to generate 40 million units. Maybe I have to only do liquid and drop the price to $6.50 in order to get to 40 million units in demand. And if I would do that combination, I would have 33% increase in profitability. So this is how you can play with these numbers, and you can go back to the forecast demand tool to plug in the price and work with the forecast demand tool to see how much the tool forecasts in your demand, and you will see if you get to the 40 million or if you get even to a higher number. For example, if we go to the combination with pots and the lower price, maybe I can get to 45 million units. And you see that now my price is down to $5.08 and my profit is up by 69%. So anyways, this calculation allows you to understand how these different variables are connected with each other. And they can also help you to prepare your decision. And then in combination with the tools that are in the simulation, especially the forecast demand tool. Okay, so that's what I wanted to share with you. And now if you have any questions, I'll open it for questions.
Hello, Professor. I have a question.
Miriam, yes.
And it's related to what Mamta asked. Yes. And actually, I've been talking to a few online students, and we did read instructions very carefully over and over. And we tried to use demand forecasting tool, but it's not very clear. I mean, I don't know. So what we are doing is we are actually inserting the numbers that we want to produce and inserting the price, but then it provides you different range. You know, in different geographic areas. It doesn't exactly tells you, you know, the number that that will be in demand or where to see that number. It's just not clear.
Yeah, that's a good point, Miriam.
So where to find the number that the tool?
There's not a single number, Miriam. It will give you a range, and you have to work with the range. This is in the real world when you do a forecast. And I don't know if you've seen forecasting tool in my class 305. We are using forecasting tools, and they give you a confidence interval. So there's not a single number, but there's a curve, and then there's a range above and below the curve that gives you the confidence interval. And the more you forecast into the future, the wider that range gets, because the future becomes more uncertain. And so that's what the simulation also does. It gives you a range, and you still have to kind of like adjust that range and see if you position yourself more aggressively at the top end of the range. So if you say the range goes from for the sake of the argument, 35 million to 45 million units, you can be more on the conservative side. For example, if I increase the price, or if I switch from a more popular formulation to powder, I would be on the conservative side, because I'm expecting that demand will go down. So I would be more conservative. If I lower the price, or I switch to a more popular formula like pots, I would be more aggressive. And some of you have experienced that before when you use the forecasting tool, or if you just make up the forecast yourself. One of the worst things that can happen, and worst things I would say in quotation mark, is that you underproduce. When you underproduce, it's frustrating because you did generate the demand, but you don't have enough units to satisfy the demand. So you will have revenue and profit that will not be generated. Basically, it's to the advantage of your competition. Unfortunately, you don't get that revenue and profit back. So when in doubt, my recommendation is always, when in doubt, rather overproduce than underproduce. So again, you won't get the exact number from the forecast tool. Just like in real life, no forecast will be 100% correct. You still have to kind of like decide as a management decision if you go to the high end or the low end or the mid-range of the forecast. But it is definitely helpful to get you in the right ballpark. It's also important you do that after you plugged in all the other numbers. I just wanted to add, it's also—
This makes great sense, because I can't see that.
Go ahead, Miriam.
Thank you.
Yeah. I just wanted to add one final comment
I was
on
just
this.
saying that.
The one final comment is, do this after you did all the other decisions that impact your demand. For example, how you allocate your advertising, which regions you focus on, which demographic groups you focus on. All these decisions have impact on your demand. So make all these decisions already and then go in the forecast demand tool, which is why I wrote in the instruction, do this last. I know some of you follow this, and then in the report, you talk about this first, which is confusing to me because then I think you did the forecast demand first. You should do it after you make all the other decisions, for example, which markets you focus on and so on and so forth. I will talk to you more about this in the debrief session after the simulation is over because I don't want to spoil all the details of the simulation now. I want to keep a little bit of suspense and for some of you, you figured it out yourself, how everything works together. But what I can say is all the decisions that you make have impact on demand. So make everything and then go into the forecast demand tool. And then you can still play around with the numbers, with the price, etc. Okay, any other questions?
Hi, Professor. This is Priyansha. Since we are talking about the forecast tool, I have one minor confusion about what Miriam asked. She said that for each region, she can see only the higher and lower values. But in the same tool, if we like scroll it down, we do see a average forecast demand. So that value can be used as a number, right?
But that's only the average. You could still go, like I said, you could go to the high end because the average would be the midpoint. That's what I call the midpoint, right? But you could, if you want to be a little bit more aggressive and want to make sure that you don't underproduce, you could go to the higher end of the spectrum.
Okay, sure. Thank you.
Yeah.
I have a question.
Go ahead.
What is the formula in cell E7 in your sheet?
E7?
Mm-hmm. This is just be so other cost remains constant.
Yeah, other cost remains constant. Yes.
Okay.
In this view, other cost remains constant, just like fixed cost remains constant. What you will see is that other costs, and I explained that in the beginning, other costs will change from year to year. But in this calculation, it doesn't matter, right? What will change other costs is if I, let's say, if I produce $292.5 million dollars in revenue because I'm choosing this and I generate 45 million units in demand, I generate $292.5 million dollars in revenue, then in the next year, my other cost will go up because other cost is a percentage of the revenue of the prior year.
Okay, and that remains constant. Is that correct? That percentage?
Yes, the percentage remains constant. Yes.
Okay, so we can just, okay. Cool, thank you.
Professor, Mamta, I have a question.
Mm-hmm. Yes, go ahead.
So if we overproduce in the current year, in the next year we produce less.
You overproduce and then in the, yes.
If you have inventory less, we produce less in the next year.
Depends. It depends on how much demand you generate in the next year.
Okay.
That's why I said when you generate with your demand forecast tool, what it gives you is how much demand you generate. So let's assume you type in these numbers and the demand forecast tool tells you you will generate demand for 45 million units, but you still have 5 million units in inventory. Then you could say, okay, I will have demand for 45 million units, but I have 5 million units in inventory. So what my production, that's the number that you actually enter into the decision, is 40 million. You basically generate 45 million demand minus 5 million inventory. So you produce 40 million units. So if that all works out, you would end up with 0 inventory.
Okay, Professor, thank you.
Okay. Any other question?
Professor, just for the clarification, that other cost is basically sum of what I spent on media and trade channel, right?
Yes, that's correct.
Okay, thanks.
The other cost, yes, that's your budget for trade channel and media. And some people say, I don't spend all the money on media, I save cost. Unfortunately, that's not how it works. It's use it or lose it. So you might as well use it. It doesn't do you any good if you don't spend the media or trade channel budget. It's
Okay,
almost like in the government. They also spend, if they have a budget, then they spend it. Okay, any other question? Okay.
Oh, I have a question, sorry.
Yeah.
So there's a question on the instructions. What were the strategies for other competitors? How do we figure it out? Like, what do they target? What do they formulate, etc.? Like, do we have to do the same analysis and somehow figure it out, or because it all shows just the results, but not exactly like their tactics? How do we answer that question?
Well, so you can look at the other competitors. You can see their revenue. You can see their prices. You have that information. Obviously, you cannot 100% predict what your competitors will do in the next year, but you can see, for example, if your competitors are losing market share, if they're losing profitability, you should anticipate that they will also do something. For example, they could also decrease their price. Sometimes students get blindsided because you make a beautiful plan, but then this whole plan gets kind of derailed because one of the competitors is decreasing their price. So if you're decreasing your price, it could be that your competitors are also decreasing their price. Or after a couple of years, if they are keep losing money, they might increase the price as well, because they just lost so much money. They have to, at some point in time, increase the price so they can stay in business. So that's why in the real world, but also in the simulation, it's always good to keep an eye on the competitors, see what they are doing in terms of price and market share, and not get blindsided by what they might be doing. So you don't have to, there's no secret formula on how to predict what the other 3 competitors in the simulation will do, but it's very good practice to analyze what their data is in order to help you be prepared for them to make also some decisions. And the main thing that will impact you is if your competitors suddenly also decrease the price.
Okay, so the price is the only thing that kind of matters when looking at the competitors. We can't really know like their targeted audience, so that will be just our
you
internal
can't.
decision.
No, well, you
Yeah.
can see what your market share is. You can see the market share in the different geographic regions. So you see in which regions your market share is growing and in which market, in which region their market share is growing, right?
I think the region-wise, it only shows for blue.
Yeah, but if your market share is growing, that means your competitor's market share is, that's why it's called market share. I mean, if you take a bigger slice of the pie, there's less for the other competitors.
Yeah, I know what market share is.
Yeah. So if you increase market share, that means their competitors decrease their market share. Okay, any other questions?
Yeah, Professor, I have a question.
Is that Jeff? Yes.
Yeah.
Go ahead.
So one of the confusions for me was setting the price per unit. I thought it had to be, I'm looking at the historical data, it's either $7, $6, some discrete value, right? So I didn't know we can set a price per unit to be like $6.50 or something in between, right? It doesn't have to be around the dollar amount.
No,
so that wasn't clear to me.
No, you can take any, you can use any number you want, any 2 decimal point number. So you could even do 599 or something like that.
I got a quick question.
Yes, Jeremy.
So, yeah, so you talked a little bit about inventory. So beside what you just said regarding the management of inventory for the following round, is there anything else that we need to worry about?
No.
To take into consideration?
No. I get asked that question sometimes. What happens if I switch formula? What happens to my inventory? So if you have inventory and you switch formula, let's say you have inventory in a year where you produce powder, and then in the next year you produce liquid or pods, your inventory automatically changes into whatever you produce in that year. So if you have powder inventory and you sell it in the next year, then you sell it as liquid and powder, liquid and pods. But I also want to warn you, some students try to game the system and they say, okay, this year I produce on purpose an excess inventory of cheap powder, and then next year I sell it as expensive pods or liquid, and so I can increase my margin. Unfortunately, that doesn't work. As this converts from powder to liquid or pods, it also takes on the per unit cost of the units that you produce that year. So you cannot game the system by purposefully overproducing cheap powder. But the good news is when you switch formulation, your inventory switches as well.
Okay, thank you.
Okay, I think we can leave it at that, or is there any more questions?
I think we're good.
Okay.
So